All right, hey there, everyone. Ooh, hold on. Give us 1 second. We're working out some tech issues. Okay, hopefully everyone can hear me. Let me know. You all can't see me right now. We know that, but let me know if you can hear me at least in the chat. And then I'm going to go ahead and share my screen. We're kind of working on a weird tech setup today because I'm actually not in my office today. And so we're trying to make everything work. So if y'all can let me know that you can hear me in the chat, that would be great. So, and I'm going to go ahead and, oh, perfect. Thank you, Alexis. Great. Okay. So I'm going to go ahead and share my screen then. I just wanted to make sure y'all could actually hear. It's not going to be as pretty. We're going to be a little clunky today, but that's okay. We're going to work through this. Okay. So hopefully, oh, there we go. There we go. Okay. I think y'all can see my screen now. Whew, we're going to make this work. So I hope everyone is doing great today. If you have questions as we go through, just drop them in the comments. I will make sure to get those answered. Oh, let me pull this off so y'all can actually, so we can, there we go. Okay, cool. So today's training is on tax deductions for online business owners. What is deductible? I get this question so much, and I like to actually, I've done this training before, but I like to update this every year. So today we're going to be covering tax deductions for primarily the 2021 year, which is the year we're in, that we're basically starting. But we'll also talk about 2020. So if you're, because we're right now recording this, we're in February of 2021. So if you're kind of gearing up to do your 2020 taxes, we'll talk about those deductions as well. And I'll just mention what's going to be different between the 2 years. So let's go ahead and dive in. So I already kind of talked about that. The one thing I just want to stress here, this is probably obvious to everyone, but the reason why we talk about tax deductions is because tax deductions reduce your taxable income, and the amount of tax you pay is a percentage of your taxable income. And so that's why when we're talking about having good accounting records, we're talking about keeping your receipts, we're talking about tracking every transaction you do in your business. That is the reason. It's all so that we can get those tax deductions so that you can reduce your taxable income and therefore your tax liability. Okay. Oh, it's so funny. I always put this slide in here and then forget about it. But we're going to be here for just under an hour. So I highly recommend you turn off all distractions, close out all those tabs. I know there's a lot going on, but we're going to go through a lot of information in an hour. And so I've personally found that it's best if you are glued into this, and then we can do all of our other stuff later. All right. So the first category of expenses or deductions. And by the way, I'm going to use those words interchangeably. I'm going to expenses or deductions. Expenses get you deductions, but I'm going to use them interchangeably. So the first category we're going to talk about are ordinary and necessary business expenses. And these are, as you'll see, basically the expenses you'll think about, or most people think about when they're thinking about business costs. The next category we're going to talk about are capital expenses. And these are, think of these in a sense of like assets of the business or things that improve the business. And I'll explain exactly what those are in a little bit. And then we're also going to talk about at the end the qualified business income deduction. This is a new deduction that came about in the 2018 tax law changes. It's been out for a couple of years now, but it's still really confusing. And by the way, it's written really confusing. It's a very complex deduction. So we're going to go over the rules for it. So a couple of notes just to make before we dive in. When we're talking about expenses or deductions for tax purposes, at least in the context today, the expenses must be for business purposes. So they have to be something that is an expense of your business. It can't just, and you can't just say it's an expense of your business. It has to be for actual business purposes. So it has to have some relevance in your business. I've already talked about that deductible expenses reduce taxable income. Most of these expenses are dollar for dollar, meaning if you spend $100 on a business expense, you'll get a $100 tax deduction. But some do have specific rules, which will reduce the amount that you actually get for the deduction. Now, not all expenses are deducted immediately. This will come into play when we talk about things like capital assets or if you're buying bigger things for your business. I'll get into the specific rules. In order to take these deductions, you must file Schedule C or CEZ. This is the schedule that you file to report your business income and expenses on your individual tax return. I do want to just point out, if you are an S corporation, you're not going to be on Schedule C. Your S corporation files a return, and then you report the income elsewhere on your return. But for everyone else, we're going to be filing Schedule C. And last but not least, make sure you keep good records. Having an accounting system is really key here. But I also, even within my accounting system, if a transaction comes through and it's not obvious from the title or the sort of description that comes through, it's not obvious what it's for, I always like to just go in and put some notes in so that if I ever do get audited, I can very clearly explain what that tax deduction was for. Okay, so the first category we're going to dive in, ordinary and necessary business expenses. Now, we're going to cover a lot of deductions today, a lot of expenses. So I'm going to go pretty quickly through these. Remember that you have access to the replay. You can always go back and rewatch it. You can, stop it and pause it or whatnot. And do please drop your questions below. But I am going to move at a pretty quick pace just because we have a lot to get through. And I'll try to slow it down when we get to some of the more complicated deductions. So when we're talking about ordinary and necessary business expenses, we're generally talking about operational expenses. These are for items that are expected to be purchased and fully utilized within that same year. So there's two pieces there I just want to point out: purchased within the tax year and fully utilized within the tax year. So this would be something like if you pay for Kajabi, you're obviously going to utilize it within that tax year. If you go buy paper, you're going to use it to print something that tax year. If you pay a social media person to do your social media for the year, that's going to happen during that tax year. So we're thinking about things that are being purchased and used in your business within this tax year. Now, remember, I called this category ordinary and necessary business expenses. Those are the two components that have to be there for all of these expenses to be tax deductions. And the first one is ordinary. So ordinary means that most other taxpayers in your same line of business would have similar expenses. So for example, I am, I'm a CPA, I do tax prep, I do business, financial consulting. If I decided to go buy, I'm trying to think of something really obscure. If I, I'm looking at it right now. If I decided to go buy a Peloton bike and claim that it was a business expense, that would be a pretty big stretch for me because it's really not something that would be ordinary in the course of doing my business. I don't need a Peloton bike to do tax returns. Now, on the flip side, if I were a spin instructor and that were my business and I went and bought a Peloton bike, that would be a different story because I could very easily make that argument that that bike is ordinary in the course of my doing my business because I need it to teach my classes and I need it to work with my clients on. Okay, so that's what we mean when we say ordinary. Now, necessary means that these expenses are used in your business and they're necessary to run your business. And this is where a lot of people get hung up because they'll say, well, was that fancy planner really necessary, or was that? Don't get too hung up in the details here. The IRS isn't going to come in and say, did you really need that? What we mean by necessary is it something that makes sense to have in your business so that you could do your business? So I'm going to pick a really random example, I suppose, or actually, here's a great example. So, let's take my business again. So I do tax prep, right? Let's assume that I do tax prep for that all of my clients are local in my town. They are all retail businesses. They're not online at all. They're all in my little neighborhood. And that I'm not looking to grow my business beyond that I only want to work with people in my neighborhood, in my town, who have retail shops. Well, let's say I buy a ticket to a conference in California, and the conference is all about online business owners. Now, let's say becoming an online business is not part of my business at all. It's not something I want to do. I don't want to attract those people. I want my retail shops in my little seaside town. The conference expense would not be necessary to run my business because it's irrelevant to what I'm actually doing in my business. Now, on the flip side, you could have another CPA, someone like me actually, who says, I do want an online business. I want to work with online business owners. So going to that conference is absolutely a necessary business expense for me because it's where I'm going to network. It's where I'm going to learn about running an online business. So because that's part of my business strategy and my model, that would be necessary in that business. So that's kind of an example of where something would be necessary or not necessary. Okay, so what I gave a couple of other examples here. So if you're a yoga teacher, yoga mats and blocks would be ordinary and necessary. A puppy that you bring to your yoga classes would not necessarily be ordinary necessary. I say necessarily because, goat yoga has certainly become the thing. So I suppose if you did goat yoga and you bought a goat, then that could actually be argued that is ordinary and necessary because you do goat yoga. But you've got to kind of think about what it is within your business. Now, advertising expense, the first category that we're going to look at. So usually advertising or marketing expense is 100% deductible. This could be something like printing business cards, paying for paid ads like Facebook ads, or really any other marketing materials. And again, as long as they're ordinary and necessary in your business, they would be 100% deductible. An example of something that wouldn't be in the advertising category, let's say I'm an online business owner for, moms that live in Florida. If I paid for a billboard in Texas, well, that wouldn't be 100% deductible because it's not necessary for my business. It's irrelevant to my business and what I do. The second category is auto expense. So this is where people can get tripped up a little bit. When it comes to the auto expense, you must be able to prove how much was used for your business. This is the first key point. So you either have to you can use like a physical paper mileage log, you can use a mobile app. You've got to have some sort of system for tracking how much mileage is related to your business versus personal, assuming the car is used partially for personal. If it's an automobile that was specifically bought for the business and is used only for the business, that's a different story. But assuming like most of us, we have a car that we use for both, you've got to track your mileage. Now, when it comes to actually taking the deduction, you can do a couple of things. You can either track your exact costs, so you can add up all of your gas and your maintenance and whatnot for the year, or you can use the standard IRS rate, which in 2020 was 57.5 cents per mile. In 2021, it actually is going down to 56 cents per mile. Take it from me, my personal preference for most clients that I work with is to just use the standard rate. It tends to be the case that is a pretty good rate. And even when I've had a very expensive car and I've spent a lot of gas and whatnot, it tends to be that works out pretty well. So that would be my personal advice to you. The other thing I want to say here is you cannot use, and I don't think I have a slide for this. Yeah, I don't. You cannot use you cannot take a deduction for like standard commuting. So you cannot track or deduct the miles from your home to your office. This is whether you're an employee actually or a business owner. And so if you're a business owner, like that, let's say back when I was in real estate at the beginning of my career, and I was a business and I owned my own business, right? I did real estate. So I could deduct mileage. In fact, that was one of my big deductions because I was driving around all the time. But what I couldn't do was deduct the mileage from my home to the real estate office because that is considered standard commuting. That's a standard commuting expense. It's not deductible. However, I could deduct miles from the real estate office to all the properties I went out to see. So just keep that in mind that if you're just going back and forth from your house to, let's say you have a co-working space or you've got a retail shop or an office, you can't deduct that mileage. That's standard commuting. Okay, the next category, bank fees and interest. This is a pretty straightforward one. This would be things like if you have a monthly bank fee, if your credit card charges you a fee, it can also be interest. So if you pay interest on a credit card, or if you have, it could even be overdraft fees. Like they're not going to not let you have the deduction just because it's an overdraft fee. So anything like that. When it comes to interest, there are rules about how much you can deduct, but they don't really kick in until you're making $25 million a year. So assuming most of you are not there yet, you can go ahead and deduct that interest. I do want to add a point in here because this has come up with a couple of clients recently. If you're using a personal credit card for your business and which first of all is not ideal. Now I understand at the beginning, especially with some of those bigger business expenses, you might not have the credit line on a business card or you might not have gotten a business card yet. So we're using that personal card. We're going to put those on that personal card. And hopefully what you're doing is you are at least recording that transaction in your business's accounting software so that you can take the deduction for whatever the expense is. But you might also get charged interest on that personal card. And so I get this question a lot of, well, can I deduct the interest on that personal card that is related to the business charges? And here's the thing, technically, in theory, yes, you can. That said, if you're going to do that, if you're going to look at your personal credit card and say, okay, 50% was personal, 50% was business, so I'm going to take as a business deduction half of the interest I paid on that credit card, you have got to really substantiate that. And what I mean by that is, if the IRS comes in, what they might look at is they might look at it and say, well, I hear that you looked at it and said 50% of your balance was personal, 50 was business, so you just split the interest. But actually, your personal items had been outstanding on the credit card for 3 months. Your business ones just got put on this month. So really that interest is related to your personal items. So if you're going to go down this path, you've really got to be super specific and make sure you're allocating it completely appropriately to when the charges were made. And that gets really cumbersome administratively. So my recommendation to folks is, unless you're talking about big amounts where it really, really matters, I would just forgo taking that interest deduction if it's on a personal card. If it's on a business credit card, it's super easy. By all means, let's go ahead and take it. Okay, so the next category, excuse me, is charitable contributions. I get this question a lot as business owners. Can I donate to charities? So first and foremost, whether you're a business owner or just an individual, you have to make a contribution to a qualified organization in order to get the deduction. If you ever have any question about that, the IRS on their website, irs.gov, actually has a charity lookup feature. Or you can ask the charity as well if they are a qualified organization, and if if donations to them are tax deductible. The one thing I'll also put in here, because a lot of folks recently have been giving more to political organizations, advocacy organizations in the last few years, is that keep in mind that a lot of these groups like ACLU, Planned Parenthood, a lot of those groups actually, donations to their organizations are not tax deductible depending on which arm of their organization you gave to. So just keep that in mind, because that's tripped up a lot of folks I've noticed recently. But assuming it's a qualified organization, in theory, you can take the deduction. So you need to keep good records to substantiate the donation. And by good records, I don't just mean the amount. So you want to have the date, you want to have the organization. If it's not a super well-known organization, something like a Planned Parenthood or Sierra Club or something like that, then you're going to want to have the address and just some information so that if you're ever audited, you can easily find that charity for the IRS. You want to have the amount, and you also want to have documented whether or not you received any benefit for that donation. Now, if it's something like NPR will send you a tote bag, that's usually not an issue, and you don't need to worry about documenting that. But let's say you donate $1,000 to a charity in your community, and in exchange, they give you 2 tickets to their gala. Well, technically, you actually can't deduct the full $1,000 because you're getting something of value in return. And that charity should give you a letter that says, thank you for giving us $1,000. This is the portion of your donation that is tax deductible, $600, $700, $800, whatever it is. And so that's the amount that you would actually be allowed to deduct for tax purposes. So just make sure you've got good records around that so that you're not caught if you ever get audited and they ask that question. Now, as I said before, contributions to political organizations, lobbyists, or candidates are not deductible. This has become a big issue in the last couple of years. And like I said, you might think, okay, political candidates, that seems obvious to me. But if it's something like Planned Parenthood, Planned Parenthood has their nonprofit arm, which is their medical centers, that those deductions are deductible. But then they also have their political lobbying arm, their 501c4, and deductions to that are not deductible. So you got to make sure you know who you're giving the money to. And then depending on your tax situation, this will either get reported on Schedule A or Schedule C. So Schedule C, it would be a contribution of the business. So if you're making the contribution from the business, you would do that on Schedule C. Schedule A is where you'd put it if you're making the contribution personally. And there are limits to charitable contributions as your total income starts getting up there, or adjusted gross income, AGI, which is the number on your return, as that starts getting up there, you may find that your contributions are limited. So the next category are cost of goods sold. Yeah, and okay, Colleen, I see your question. So hold on. What is the details on products I send out? A lot of gift baskets, certificates. Yes, perfect. Okay. So Colleen is asking, she sends out a lot of gift baskets, certificates, and donations to food pantries, schools, and local groups. Yeah, those are absolutely business expenses. So, because in those cases, you're making a donation to, so actually, this is a two-part answer. So the first part is if they are a qualified organization. So I'm going to guess the food pantry probably is. The local groups may or may not be. If they're qualified organizations, then you are absolutely going to record that as a charitable contribution from the business for the value of the gift basket or the gift certificate or whatever it may be. On the other hand, if they're not a qualified organization, so let's just say, oh gosh, I'm trying to think of an example, but if it's like a parents group or, I don't even know, or even something like the schools, if you're just sort of giving it to the school, which is not on its own a nonprofit qualified organization, then in that case, I would put it as a marketing expense, because that's really what you're doing, is you're giving them something of value from your business for the purposes of marketing. So that's kind of a different one, where you're kind of providing free product for the purposes of marketing. But if they are a qualified organization, I would absolutely book that as a charitable contribution. So hopefully that explains it. Let me know if that didn't. So the next category is cost of goods sold. And Colleen, this one's going to definitely apply to you. These are materials used to create your products. So this typically is only relevant if you have physical products. I do know some people who will, in their accounting systems, is some people who sell like courses or memberships or whatnot, who will categorize expenses that are directly related to the delivering of those services as cost of goods sold. But technically on your tax return, that's not where we would put those costs. So mostly for product-based businesses here, physical product-based businesses here, and this is going to be everything that you purchase or you acquire to create your product. So all of the different materials, so I've said this before, but if I made notebooks, this is like my classic go-to example. If I made notebooks and I had to buy the paper and I had to buy fabric for the cover and I had to buy the binding, and I had to buy, pens that went with it at the top, those would all be costs of goods sold. They are materials that are used to create my products. And the key here is that they're directly connected to the creation of that product. We're not talking about shipping here. We're not talking about boxes to ship things in. We're talking about things that are directly required to make the product itself. These are deductible when you sell the item or when you write it off. Now, I do want to point this one thing out here, because this tends to confuse some folks. So stick with me. There are two systems of accounting that exist. There's the cash system and the accrual system. The cash system is just like it sounds. You report your income when you receive the cash or the money in your bank account. You record your expenses when you pay for them, whether on a credit card or you write a check or you take the money out of your bank account. Excuse me. The accrual system is a little bit different. The accrual system says that we don't report our income until it's earned. So for example, let's say someone pays me today for an event that I'm having in 3 months. They give me $1,000 today, but the event isn't until April. I am not going to record that income as true income until the event happens, because I haven't earned it yet. On the flip side, if on the accrual system, you don't report record your expenses until you incur them. So, an example of this would be, if I prepaid for something, if I prepaid for an expense, tax prep, you pay today, but the tax prep hasn't been, isn't going to be done for 6 months. That's not an expense that I would record until I've actually incurred that expense. The reason I bring this up is most of the folks in my community and most of the business owners that we all kind of associate with are on the cash basis. It's the simpler of the two. For those of you with physical product-based businesses where you have inventory, you're most likely on the accrual system because in pretty much all situations, you're required to be on the accrual system. So this is where the cost of goods sold comes into play. Those expenses are only deductible when you sell the item or write it off. My cash basis taxpayers, this is why you don't who don't have physical products, who don't have inventory, this is why you don't want to start coding things as cost of goods sold in your accounting system, because they're truly not cost of goods sold in the way that we think about them for tax purposes. So hopefully that made sense, but let me know, y'all, if you have any questions. Okay, so our next category, super simple, dues and subscriptions. This would be something like if you're part of a business membership or a business club, if you have subscriptions to newspapers or periodicals or business magazines. These are simple, 100% deductible, easy enough. Education and training, this one does have a little bit of a trick to it. So the education and training has to be related to your business, and it has to improve your skill set. So it cannot be to either enter a new industry or a job. And I don't know if I put, no, I didn't. Okay, so I'm gonna just tell you the examples. So an example of this that I like to give is if you are a real estate agent and you pay for classes to prepare for the real estate exam. Those classes are not tax deductible because they are, at least not as a business expense, because they are preparing you to enter a new industry or job. They are not furthering your skill set within a current industry. Now, those classes may be deductible as an individual under the, there are tuition, education credits and deductions as an individual, but they're not deductible as a business expense. So, someone brought this up actually the other day, a client brought this up, an example where she had to get certified as a coach and go through classes. And I said, the question I asked was, well, number one, is the certification, required to do your job? So for example, if I was required to have my CPA license, I'm not required to have it to do tax prep, by the way, but if I was required to have it for some of the services I provided, me taking classes to get my CPA license would not be deductible as a business expense. Now, that said, I'm not required to have my CPA license. Having it is something that I do to further my skill set. It's related to my business. It gives me more credibility. And so when I'm going to renew that CPA license, any of the courses I have to take to renew that license can absolutely be tax deductible as a business expense. So hopefully that makes sense. But this one gets a little tricky. And if you'll have questions or specific scenarios you kind of want to throw at me, go for it. But that's what it really comes down to is it allowing you to enter a new industry or job, and or is it required to enter that new industry or job? If either one of those is true, it's probably not deductible as a business expense. Okay, the next category of deductions are employee pay and contractors. So this is everything from wages for your employees to bonuses to commissions to benefit programs if you provide medical or dental or retirement, things like that. It's whether you're paying employees, whether you're paying consultants, contract labor. And we also need to include in this taxable fringe benefits. So when we talk about fringe benefits, we're talking about benefits that the person receives that are not part of their main compensation, meaning I'm going to pay you $50,000 a year, but they are a benefit that you're providing them. Health insurance is a great example here. If that is something that is taxable to the other person, that it is something that we can deduct. So you may not have ever noticed this, but if you've gotten a paycheck in the past, if you've been an employee, you may have noticed that the sort of amount of compensation you received was actually different than what you thought you were receiving. And that's because they're including in that taxable compensation amount those fringe benefits that you were given. Now, you are not allowed to deduct payments that you make to yourself or other owners if you are a sole proprietor, if you are in a partnership, or if you are in an LLC. So when I pay myself out of my business, that is not a business deduction. It is not a tax expense that can be a tax deduction for me. That is simply returning or disbursing profits from the business. Okay, makes sense. And by the way, this also includes taxes we pay too. So if you have employees and you're paying payroll taxes, those are deductible for you as well, the ones that you're paying. Okay, so the next category is gifts, and this one, very sadly, always nabs a bunch of people. Because a lot of us give gifts in our business. We love to give gifts, right? So these are gifts that you're going to give to customers or clients, thank you gifts, birthday gifts, whatnot. There is actually a limit on how much you can deduct, and that for tax purposes, and that limit is $25 per person. Now, you can spend more than $25 if you want. That's your choice as a business owner, but you're only going to be allowed to deduct $25 per person. They do allow you to deduct separately the shipping costs, and also if you have it engraved, that can be a separate cost. So $25 basically for the gift, and then shipping and engraving separate. So you could, in theory, go above that $25 limit, but that is the limit per person. Now, there is one exception to this, and that's promotional gifts. So if you give out like pens or, I don't know, tea towels or something like that, and they've got your logo on them, as long as they're $4 or less per gift, then you can fully deduct those. So if you've got promotional items, $4 or less, you're fine to fully deduct them. Okay, so the next category, health insurance premiums. This is actually a really good one to be aware of if you are, in fact, self-employed, and if perhaps you don't have access to health insurance in some other way. So in order to deduct health insurance premiums that you pay for yourself, you have to be self-employed, so you can't be an employee of your business. You must pay for your own health insurance premium. So again, you have to pay them yourself. And you cannot be eligible to participate in a health insurance plan through your spouse's employer. So even if you decide not to take advantage of your spouse's employer's health insurance plan, if you are even eligible to participate in it, you cannot deduct your self-employed health insurance premiums. Now, assuming that is not the case, you can deduct 100% of these premiums, health, dental, and long-term care for you and your entire family. Now, I do also want to note this thing about if you're eligible through a spouse's employer's plan, that's actually looked at on a monthly basis because most health insurance premium payments are monthly. So let's just say your spouse had a job January through March where they had access to health insurance. You wouldn't be able to deduct your health insurance premiums if for January through March. But let's just say come April, your spouse left that job and was now self-employed, him or herself, then you could start in April deducting those health insurance premiums. So it's not an all or nothing for the year. It's looked at kind of on a monthly basis. Anything for gifts for employees or either monetary or products? Yeah, so it's a great question. So going back to the gifts question with the $25 limit. So this one gets a little tricky. It kind of depends on exactly what the gift is. So you had said like either monetary. Monetary would really be a bonus. That would be a bonus to them. We wouldn't call that a gift. We would call that a bonus. And so that would actually have to be treated as compensation. So you'd be able to deduct it 100%, but you'd also want to make sure in your payroll system or in your accounting system, it gets recorded as compensation so that when you issue them the W-2 or the 1099, whichever one you do, depending on if they're an employee or a contractor, that is getting added in their total compensation because they absolutely need to pay tax on that. If you're talking about just sort of like a nice gift, like at the holidays or whatever, it's going to be those same rules, that $25 per person rule. Once we get above that for employees, then we're really talking about it being a taxable fringe benefit to them. So if you, let's say you give every employee once a year, you give them like a trip to the spa and it's $500. That really becomes a taxable fringe benefit, meaning they're going to pay tax on that because it's compensation to them, even though you're giving it in the form of a spa gift certificate and not writing them a physical check. So hopefully that makes sense. Okay, so the next deduction we're going to look at, we're kind of in the range where we've got a few complicated ones, but we're almost through. Because home office is another one that can get a little complicated. So home office deduction can be taken for only the parts that is used for business. So you've got to be super clear about this. You cannot take it for any other space. It's got to be used for business. And that space has to be used regularly for business and exclusively as the principal place of business, a location to meet clients, or a separate structure used in the business. So this is really where I want to stop for 1 second, because this is the important part. Let's just say you are a hairstylist and you own a hair salon somewhere else, hair salon outside of your house, in the center of your town. If you have a desk in your home where you'll come and you'll do some like bills for the salon or do some scheduling or whatever, you're not likely going to be able to take that space in your home as for the home office deduction, because the principal place of your business is elsewhere. Okay. So this is where, like if you have a co-working space and that's the principal place of your business, that's primarily where your business is done, you can't then also take the home office deduction. All right. Now, where this has gotten a little tricky for 2020, as you might imagine, is because of COVID. And with a lot of folks having their co-working spaces shut down or their offices shut down and not being able to go to those, this is going to get a little dicey. And as of right now, I haven't seen a ton of guidance from the IRS on this. The way that I'm going to treat this with my clients is, if the principal place of your business in 2020 changed because of COVID, even if temporarily, if it changed, meaning your co-working space shut down and you could not be there, then we can now look at the home office deduction. But I'm just going to use the co-working space again as an example. Let's just say your co-working space didn't shut down and you continued to pay for it. You just chose not to go there. Then you cannot take that home office deduction. Instead, you're going to continue to deduct the co-working space rent, but you're not going to take that home office deduction. So that's how I would look at it for 2020 specifically. Now, you also cannot have any personal use in the space. And this is the one that gets a lot of people tripped up as well. So you cannot deduct your kitchen table. You cannot deduct your living room sofa. You can, however, let's say you have kind of a study in your house, and let's say half of it was used for you and the other half was used for your kids to do their remote schooling. You can deduct that half of the room. So it does not have to be its own completely enclosed room to be deductible. But what you do have to do is you have to make sure, if that's the situation for you, that it's not completely closed off. You have to make sure that there is a clear boundary between your workspace and whatever else that isn't business related. And I don't mean you have to like build a wall. I just mean it has to be very clear. If I'm an IRS agent and I walked in there, is it very clear to me, oh, there's your desk, there's your work table, there's your filing cabinet. Okay, that is clearly your business. And none of that stuff is used for personal purpose. And over here, completely separate, I see the personal use stuff. Totally get it. That's okay. All right. So hopefully that makes sense. You can do one of two things when you are taking the home office deduction. You can either do the simplified calculation, which is $5 per square foot up to 300 square feet, or you can look at your actual expenses. So if we're going to look at our actual expenses, there are going to be two categories here. The first category are those direct expenses. This would be like if you had a she shed in the backyard and that was your office and it was on its own utility line, or you had its own phone line going out there or something like that, that was specific to that space and not used for any personal purposes at all, then you would take 100% of those amounts. For everything else, like your mortgage, your rent, your homeowner's insurance, your general utilities, your internet, things like that, you're going to take basically a percentage of those. So if you have a 1,500 square foot house, 500 square foot office, you would take a third of those expenses. And I'm pretty sure I've got some examples. Yes, I do. Perfect. So example number one is Kate. She does social media management. She has a private office in her home. It's 250 square feet. She opts to take the simplified calculation, $250 times the $5 per square foot. That gets her a $1,250 annual deduction. Pretty cool. Okay. Super simple. My second example is Emily. Emily is a wedding planner. She's got just a little office nook in her house, so it's not completely separate, but it is clear and delineated that it's just for business. She has a 1,000 square foot home, 125 square feet is her nook. And she's also going to do that simplified calculation. So that gets her a deduction of $625 per year. Now, a couple of examples to show you sort of the actual expenses. So if our rent for the year is $24,000. Our utilities are $2,400. Our insurance, $600. Our Wi-Fi, $1,200. Security system, $600. Total expenses are $28,000. Actually, that's not right, is it? Oh, no, it is right. Sorry, $28,200. I looked at the numbers wrong. So total expenses are $28,200. The amount per square foot, then this is for, go back to our girl here, Emily, 1,000 square foot home. The amount per square foot is $2,820. And so if we multiply that $2,820 by her 125 square foot nook, that gets us to an annual deduction of $4,230. So you can see in that example, it makes so much more sense for her to actually take the time to do out her actual expenses. What you will find as you do this for a couple of years, assuming your home expenses don't change that much, is you'll find that you figure out pretty quickly which one makes more sense. And then you'll know each year whether it makes sense to do simplified or actual. Okay, so our next category, and I'm just going to go a little slowly here because there's usually a lot of questions about home office, and I know there's a bit of a lag, so I want to make sure if anyone has home office questions, y'all can get them in there as I start talking about insurance. So insurance is 100% deductible if it's solely for your business. This would be things like professional liability insurance, property insurance, if it's for business property specifically, workers' comp, home-based business insurance, product liability insurance, and vehicle insurance. As long as it's for the business, it's 100% deductible. Super simple. Interest paid, we've already talked a bit about interest when we talked about the bank fees, but just a couple of things to note when you are taking that interest deduction. The deduction in each year cannot exceed your total business interest income for the year. And it also cannot exceed 30% of your adjusted taxable income for the year and your sort of floor kind of financing interest expense for the year. So basically, it gets a little dicey here how much you can actually take. And there are some limitations there. And again, I said this before, if your annual gross receipts are less than $25 million, these rules do not apply. So as long as you're not making $25 million a year in your business, then you're good and you can go ahead and deduct that interest. Legal and professional fees, 100% deductible if they're necessary and directly related to your business. This would be lawyers, accountants, consultants. You do have to remove fees for personal services. For those of you who do tax prep with me, one of the things you'll notice when I do your tax returns is you'll notice that I siphon out a bit. If you've put my entire fee as a business expense, I'll probably cut some of that out. And that will be the part that is related to doing your personal return because that is not deductible as a business expense. So just note that. If you work with someone else to do your tax return prep, make sure you ask them that question so that you're not inadvertently taking too much, as a deduction for your tax prep fees. Licenses and permits. So these are 100% deductible if they're required to run your business. Professional licenses, alcohol resale licenses, resale permits. These are kind of straightforward deduction. Okay, so meals, this is one that's actually changed a bit and is always a little bit confusing. Most meals are 50% deductible if they are in the course of doing business. So this would be if you are sitting down with a client, which I know no one is doing right now, but if you are sitting down with a client and you're talking about business, and that meal is going to be 50% deductible. Now, food for the public or for employee events may be 100% deductible, excuse me, if it's for essentially the purposes of the business. So if you're having an event that you're inviting the public to, or if you are having something like an employee appreciation event, that would be 100% deductible. This does not count for meals that you're giving to employees for meetings. So it doesn't count for meals that you would otherwise expect the employee to just bring their food for. In order to take these deductions, you do have to keep receipts. You have to note what was discussed with whom. As much detail as possible is going to help you get out of trouble if it's ever questioned. And very importantly, they cannot be lavish or extravagant. So you cannot take you cannot throw a $100,000 party for your 10 employees and deduct 100%. That's not going to fly. And the taxpayer and or the employee must be present at the meal. So you can't just send your clients out to a meal and deduct it. Somebody's got to, either you or an employee has to be present there. So just a couple of examples here. So lunch with a client, 50% deductible. Dinner while traveling to a conference, also 50% deductible. We'll talk about this a little bit more when we get into travel, but just because you're traveling does not make it 100% deductible. Snacks in a break room, 50%. Employee appreciation party, 100%. Real estate open house, 100%. Colleen says we often bring in lunch on our busy days. Yeah, totally. So that would be that would be 50% deductible. It's not 100% because again, the idea is that it's not a business expense to provide your people with lunch. Like they would otherwise have had lunch on their own or dinner on their own. So you don't get the full 100%. You do get 50% though. So you still get that deduction. When you're booking this in your accounting system, just book it as meals and entertainment, and your accountant should know or should be asking you, okay, what was this for? And then let's figure out which ones are only 50%. Entertainment is no longer deductible. This went away with the 2018 tax law changes. This would be something like, a golf outing or getting a suite at a sporting event or a concert. Now, the food and the beverage at the entertainment event can be deductible as long as it's separately stated on the invoice or it's separately paid for. If you're renting a suite that comes with unlimited food and beverages, that food and beverage are not deductible. If you rent a suite and there's an add-on food beverage package, then you can deduct that package. It's just got to be clear what is food and beverage versus what is entertainment. Merchant processing fees, this would be like, when someone pays you through Shopify or PayPal or Square, these are 100% deductible as long as they are related to your business. Mileage, we talked about this a little bit when we talked about the auto expense, but business miles have to be separate from your personal miles. Got to be doing this for business purposes. You cannot include those commuting miles. The standard mileage rates are there, 57.5 cents in 2020, 56 in 2021, or you can deduct your actual expenses, which would be depreciation on the vehicle itself, loan interest, gas, maintenance, and insurance. Note, you cannot deduct your entire auto payment. You do have to separate out principal and interest, and you cannot deduct the principal. It's only the interest. So here's an example. If you had 5,000 business miles using that standard mileage rate, $28.75 annual deduction. Another example using actual expenses. So if you had 12,500 miles, 5,000 of which were business miles, so 40% of your car use is business, and you had expenses of $1,250 for your interest, $1,300 for gas, $600 for insurance, you'd get a $1,260 annual deduction for that. Office costs and supplies, 100% deductible, again, as long as they're reasonable, they're ordinary, they're necessary, related to your business. Printing and copying, same thing, 100% deductible as long as they are ordinary and necessary for your business. Rent, 100% deductible, again, as long as it's ordinary and necessary for your business. And as long as we're not talking about rent for your personal residence, that would be under the home office deduction. Retirement contributions, I'm not going to spend too much time on these because these can get pretty complicated. There are a bunch of different types of retirement plans. I'm going to run pretty fast through these. As you're watching, let me know if you have questions. I'm happy to kind of follow up. But these are the different, and I want to say, yeah, I'm going to go slide by slide. So the first type is actually the traditional or Roth IRA, and they are different. So contributions to a traditional IRA are deductible, but the distributions when you eventually take them out, when you retire, are taxable. You cannot make deductions for contributions to a Roth IRA, but on the flip side, when you take those out, when you retire, those distributions are tax-free. And there's a limit on the amount you can deduct. So you can contribute up to $6,000 a year plus a $1,000 catch-up if you are 50 or older. And that is the same numbers for both 2020 and 2021. The Simplified Employee Pension, or SEP, contributions to this are tax deductible. Distributions are taxed as income. So that's going to pretty much always be the case that if you get a deduction for contributing, you're going to pay tax on the distribution. If you don't get a deduction for contributing, you're not going to pay tax on the distribution. For the SEP, you can contribute as much as 25% of your net earnings from self-employment up to $57,000 in 2020 or $58,000 in 2021. With a 401k plan, so the contributions are made pre-tax, but distributions when you turn 59.5 years old are taxed. So you get that deduction up front, but you're going to pay tax on the income when it's distributed. With the 401k plan, we look at what's called the employee portion and the employer portion. So the employee portion, you can contribute up to 100% of your salary or up to $19,500, whichever is less. There's an additional employer portion, which is an additional 25% of net self-employment earnings up to $57,000, plus the $6,000 catch-up if you are 50 or older. That's for 2020. And then it's $58,000 plus a $6,500 catch-up for 2021. So as you can see, there can be a pretty significant contribution limit and deduction for that, depending on if you have the funds to do that. With a simple IRA, contributions are deductible, distributions are taxed. Contributions made to employee accounts are also deductible. So if you have employees and you want to set up retirement options for them, this could be an option for you. And those contributions you make to their accounts are deductible. You can contribute up to $13,500 of net self-employment earnings, plus an additional $3,000 if you're 50 or older. Plus, one gets a little complicated. You can also do a 2% fixed contribution or a 3% matching contribution. And that's the same whether it's 2020 or 2021. Defined benefit plans, contributions to these are generally tax deductible. Distributions are taxed as income. How much you can contribute is actually calculated by an actuary based on the benefit that you set. So this is a defined benefit plan is essentially where you're saying, in the future, we'll guarantee X benefit that you'll get. So that's how it decides how much needs to be contributed. And there are no other contribution limits beyond that. The Keo plans, I put these here simply because a lot of people know this term. Self-employed retirement plans used to be called Keo plans. They actually don't exist anymore. This law no longer distinguishes between corporate and other plan sponsors, so we don't use this term anymore, but I add this here in case you know this term and we're thinking about it. This is not something you need to be aware of anymore. So that was retirement, and I just want to say one thing before I move on from that. There are a lot of specific rules about the different types of retirement accounts, as you just saw. I went through those really, really quickly. If you are thinking about setting up a retirement account for either yourself and or your employees, this is definitely something I would do your research on. I would talk to an accountant about, because there are, even beyond sort of the tax aspects of it, there are legal requirements for some of these as well. So you want to make sure you set up the right plan for what you're trying to accomplish. Okay, moving on to self-employment tax. There is a 15.3% tax on self-employment income. Essentially what this does is it replaces, if you were ever an employee, you may recall you had payroll taxes taken out of your paycheck for Social Security, for Medicare. There was an employee portion, the part you paid, and then there was an employer portion, the part your employer paid. In total, that was 15.3% of your earnings. And so now that you're self-employed, you've got to pay that entire 15.3%. But because you're the employer, I'm putting bunny ears around that, you can deduct 50% of this tax. So essentially the employer portion. And you can do this whether or not you are an employee of your company, in the sense that if you're just a sole proprietor, you can still absolutely get this deduction. Okay, so the next category, shipping expenses, these are pretty simple, 100% deductible, again, as long as they're ordinary and necessary in the business. This is everything from delivery charges to postage to shipping and handling, to boxes, to ship stuff, to the tape, all of that's deductible. Tech, 100% deductible, again, as long as it's ordinary and necessary. This could be internet subscriptions, domain names, hosting, software, your telephone, all stuff like that. Travel, this can get a little complicated, so stick with me here, but basically what we think about when we talk about travel for tax deduction purposes is we think about this concept of your tax home. So your tax home is really wherever your sort of residence is, as you indicate on your tax return. So for most of us, that's our home, but just want to make that clear. So travel is going to be anything that is away from your tax home that is substantially longer than an ordinary day's work, and that requires you to sleep or rest while away from home. So, if I drive an hour down the road, that's not really going to be considered travel. So if I drive an hour down the road and get a hotel, not really going to be able to deduct that on the claim that I was traveling and therefore had to get a hotel. Travel does have to be temporary, meaning it lasts less than a year. Once you go beyond that, then it becomes a question of, has your tax home changed? So again, your tax home is your regular place of business. It may be your residence if you work in multiple locations. So if you've got, a hair salon or a co-working space or a retail shop, that's your tax home. If you drive out to see your clients, like maybe you're a massage therapist, you go to people's houses, then your tax home is going to be your residence, assuming you don't have a massage studio. So what can you deduct for tax purposes when you travel? Well, you can deduct your hotel, certainly. The room charge, the taxes, laundry, phone calls, that's all deductible. You cannot deduct gym or fitness center fees or movies, like sort of any kind of entertainment stuff you might add on. You can deduct per diem rate. So these are reasonable amounts for daily expenses that are deductible. They're set by the IRS. There's like a whole chart. You can find it by going to irs.gov. So you can deduct those as well. So for example, if your employees travel and you give them per diem, that is deductible for you. You cannot deduct air travel if you use miles. So just note that. I personally love to rack up my miles, but I try really hard not to use them for business purposes because then I'm just not going to be able to get that deduction. When it comes to meals, they're either 0% or 50% deductible. So a lot of times, so they're 50% deductible if you travel and you meet with a client under those same rules we talked about before. A lot of times people will say, well, I had to travel because of my employer, so I should get to deduct, I had to travel for a conference, I'm a business owner, I should get to deduct the lunch I had to buy. And the answer is actually it's not deductible because again, the idea is that you would have had to provide lunch for yourself anyway, even if you were at home. And therefore it isn't something that you should get a tax deduction for. That one always kind of trips people up. So if you have any questions about that, just let me know. A lot of people will ask, well, what happens if I do some personal stuff on this trip? So if you're traveling within the US, the trip can still be 100% deductible as long as your personal time is no more than incidental. So, if you travel to California for a 6-day conference and on the 7th day you decide to like pop into Disneyland, that's probably fine. That's pretty incidental. If on the flip side, you travel to California for a 2-day conference and then you spend 7 days at Disneyland, that is definitely going to taint your ability to take 100%. Yeah, you're so welcome, Colleen. Oh, and so exciting. Run and build a snowman. I love it. If you are traveling internationally, the rules are actually very specific and very complex in terms of business and personal. So I'm not going to go into that specifically here, but if that is the case, talk to your accountant, talk to me. I can get you those rules. You also cannot deduct costs for a spouse or child unless they are employed by the business and they are performing substantial business-related tasks on the trip. So I often get this question of, well, I have to go, I don't know why, I'm going to keep using California, but I have to go to California for a business conference. Can I deduct my husband's airfare? And the answer is no, unless your husband is an employee of the business and they are actually performing business-related tasks on the trip. Now, I went out to California a couple of years ago and for a business conference and got a hotel. My husband and son came with me, obviously stayed in the hotel room with me. I was able to deduct the hotel because it's an expense I would have deducted either way, but I was not able to deduct their airfare because they were not there for business purposes. Okay, so that was all of our ordinary and necessary business expenses. I know we're just about over 1 o'clock. We're actually getting close to being done. This is taking a little bit longer because we started a little bit late, but we're very close to being done. So we're on our second category now, which are capital expenses. And these are, there are fewer of these, so it'll be quicker to run through these. So capital expenses are for the purchase of assets whose useful life or value is greater than 1 year. So think of this like if you were buying a vehicle for the business, or you were buying a computer for the business, or you were buying a building for the business. These would be capital expenses, capital assets. So generally with capital assets, we have to depreciate them over time, which means we deduct them over time. So for example, if we buy a business, we'll likely deduct the cost of, buy a building, if we buy a building, we'll likely deduct the cost of that building over the next 30 years instead of taking it all in this first year. Now, there are some exceptions. to basically allow 100% deduction in the year that you purchase it. These exceptions exist only for tangible property like a computer or a car, and not for real property like a building. And so the length of the deduction period or depreciation period depends on the type of asset. And there's actually a very specific chart where it says, if it's mechanical, if it's electrical, if it's a building, if it's et cetera, and it gives you the number of years that you have to divide the cost over and take that deduction over. So here are just, again, some examples: buildings, computers, machinery, vehicles, furniture, R&D or patents if you do any sort of development work. Now, there is a category called startup costs. Startup costs must be related to actually starting your business. So you're going to incur these at the beginning. And these would be things like market research. They might be travel if you are investigating different locations for a business, for example. They could be advertising. They could be attorney and accountant's fees. You can deduct for startup costs up to $5,000, and you can do that at the beginning. So you don't have to depreciate those over time. We also have something called organization costs, and these are costs that are related to organizing the business. So startup costs are to kind of get everything figured out, get sort of all the pre-work done before the business starts. Organization costs are costs to actually get the business set up. So these would be state filing and legal fees if you're going to be an LLC or a C Corp. They would be professional fees if you're bringing on an accountant to file that S Corp election, for example. And these you can also deduct up to $5,000 right away. Okay, so our last category or last item is really actually just one big deduction on its own, and this is the qualified business income deduction. This, like I said before, this came out in 2018 as part of the tax law changes that were put through. So this is essentially a 20% deduction on business income from services and rental real estate. So, hold on. I don't know why. That's so funny. Colleen's question is still up there all of a sudden. There we go. Okay. It's like, I don't know what I did, but I put her question up there by accident. So with the qualified business income deduction, it's 20% on business income from services and rental real estate. You can take this if you are a sole proprietor, a partnership, an S Corp, an estate, a trust, an LLC. You cannot take it if you are a C corporation. And it's not for specified service businesses, with one exception, and I will explain what specified service businesses are. So the deduction is only on your US source income. So if you also have income in other countries, you don't get a deduction off of that. And it does not apply on your self-employment tax. So you've got to back out that self-employment tax deduction before you take the 20%. So the deduction is 20% of the lesser of your net qualified business income or your taxable income before the deduction and after reducing for net capital gains. This is where it gets really tricky. And I'm just going to give you one sort of heads up here. I don't expect you to walk away from today knowing exactly how to calculate this. I want you to have a general sense for how to do this, but this is a complicated calculation, and this is definitely something you should work with your accountant on, or if you use like a tax prep software, just kind of review and make sure that they're looking at this deduction for you, okay? Because it's got a lot of twists and turns. So remember I mentioned it's not allowed for specified service businesses with one exception. Well, what's a specified service business? So a specified service business is an occupation that provides personal services with the exception of engineering and agriculture. And the reason is these are businesses where the majority of the value in the business is the personal services of the people in the business. So an example would be healthcare services where you have doctors, nurses, and dentists. Legal services, the lawyers are the value behind that. There's nothing else in the law business. It's the service the lawyers are providing. Same thing with accounting, actuarial services, performing arts. The value is in the actors or the singers. That's what you're paying for. Consulting, athletics. So a lot of us, especially in my community, likely fall under the specified service business category because the majority of the value in our businesses is us. It's what we provide to the business. An example of a business that wouldn't be a specified service business would be something like Colleen's business, where she sells a physical product, because the value of what her people are paying for is not just her, it's the product as well. Now let's answer this question of, okay, well, what is qualified business income? Because if you go back a couple of slides, remember I said the deduction is 20% of the lesser of net qualified business income or taxable income before the deduction and after reducing for net capital gains. So what's net qualified business income? Let's talk about this. So net qualified business income is the net amount of your business income and deductions for your trade or business, but you have to back out some things. It does not include compensation paid to you. It does not include capital gains or losses. It does not include dividend income. It does not include interest income that isn't connected to the business. And it does not include any net gains from foreign currency transactions. Now, a lot of you aren't going to have any of that stuff going on, but I just want to make that clear. So for example, if you've got an S corporation and you've paid yourself compensation, you've got to back out that compensation. Now, how do you calculate this? Well, the tentative deduction is 20% of qualified business income. So a simple example would be that Jane owns 100% of her LLC, a qualified business. The LLC's qualified business income is $50,000. So the tentative deduction is 20% of that, or $10,000. I think I said, so the qualified business income is $50,000. The tentative deduction is $10,000. There is also a wages and property limitation. This is where if your head's not already spinning, it's going to start spinning. I told you this deduction is really complicated. But basically, even once you've calculated that 20%, then you have to look at if that deduction is even further limited. And it could be further limited by this limitation. This limitation is 50% of W-2 wages. So if your taxable income exceeds a certain threshold, that threshold changes every year, the deduction is limited to the greater of 50% of the W-2 wages that you paid in your business. So those are, when we say W-2 wages, those are wages you pay your employees, or the sum of 25% of those wages plus 2.5% of the unadjusted basis immediately after acquisition of all qualified property. That was a lot of big words. And I'm guessing most of you are thinking, I wouldn't even have a clue how to calculate that. And that's why I say that this is one of those things that you're going to want to talk to your accountant about. Have them work through this calculation with you because it is very, very complicated. An example of this limitation, this is a very simple example, is Jane paid $12,000 in W-2 wages during the year. Remember, her income was $50,000. Her initial deduction, the 20% we thought was going to be $10,000, okay? So Jane pays $12,000 in W-2 wages during the year, so 50% of that is $6,000. She's got no qualified property. So therefore, 25% of the W-2 wages is $3,000. So remember that limitation. It's the lesser of 50% of the W-2 wages, or 25% of them, and 2.5% of the qualified property. So in this case, the lesser is going to be that $3,000, 25% of the W-2 wages. And so the greater, it's greater of these two, excuse me. So the greater of these two is 50% of the W-2 wages, $6,000. So that's what we can use to figure out what her limitation is. So in this case, she is entitled to deduct the lesser of 20% of her qualified business income, $10,000, or 50% of her W-2 wages, $6,000. So her actual qualified business income deduction is $6,000. Okay, so there also are some exceptions to the wages and property limitation. If you already don't want to strangle the person who wrote this tax deduction, I'm guessing this might do it. So one of the exceptions to this wages and property limitation is that it does not apply when your taxable income is less than $315,000 if you're married filing joint, or $157,500 for everyone else. So you may find that you don't even need to look at this wages and property limitation. The W-2 limitations are phased in between, so once you hit that $315,000 mark if you're married filing joint, or $157,500 if you're single or some other status, they don't completely go away. They start to phase in or phase out between $315,000 and $415,000 if you're married filing joint, or $157,500 and $207,500 for other filers. So basically, if you are married filing joint and your income is $415,000 or above, you are subject to the full limitation. Now, remember I said there are also exceptions for the specified service businesses component. So let's just go back real fast because this is a lot. I just want to remind you real fast. We talked about specified service businesses are businesses where essentially the majority of the value that the business provides is because of the services of the people. We talked about how you actually cannot take the qualified business income deduction at all if you are a specified service business, but there is an exception. And this exception is pretty important. So I would pay attention to this. If you are a specified service business, you can still take the 20% deduction if you are below certain income levels. So if you are a single filer, and your income is below $157,500, you can fully take that qualified business income deduction. The deduction starts to phase out at $157,500, and it fully phases out at $207,500 if you're single. Those numbers are $315,000 and $450,000 if you're married. So if you have income of $315,000 or less, even if you're a specified service business, and you're married filing joint, even if you are a specified service business, you can take the deduction. It phases out starting at $315,000. It fully phases out at $415,000 of income. That was a lot. I know. Everybody breathe. Okay. So that was the end of all of our deductions. And that was the end, especially of that qualified business income deduction. And I cannot stress enough how if you, that you should absolutely talk to your accountant about that deduction, or if you're doing your taxes yourself, look at your software and make sure that it is considering that deduction for you and properly taking the deduction for you. When in doubt, my rule when it comes to deductions is always to track everything, because at the end of the day, if the IRS ever comes in and questions you or audits you, it's always good to be able to show your documentation to show why something is legitimately a business expense, and basically to just back it up. And if you don't have that, that's where they can question the deduction. That's where they can potentially take away the deduction, which results in you potentially owing more taxes, owing fines and penalties on those taxes, and it's not worth it. So when in doubt, track it. And, the other thing I will say is you will find accountants who will be really loose with the kinds of deductions you'll take, and you'll find ones that'll be really conservative. It's been my experience or it's my personal preference, I should say, that it's not worth risking being audited, having massive fines and penalties for a deduction that I know deep down probably isn't a legitimate deduction. So I will leave you with that. And then, of course, last but not least, if you are not already in our free community, you can join us there by going to megkwheeler.com/group. And I'm going to give it just a second or two in case there are questions, because I know there's a bit of a lag. But if you are watching this on the replay, by all means, feel free to put questions in the comments. Feel free to join the weekly or our weekly Q&A in the Badass Moneymakers group, the free group, our monthly Q&A in the paid members group. Lots of places to get those questions answered. So I'm just going to give it another minute or two and before I close out. And then thank you again so much for everyone for being here. Sorry we went a little bit over. Deductions always take a little bit long to go through. Feel free to watch the replay. And again, let me know if you have any questions. All right, y'all. Hope you're having a great week, and I will talk to y'all soon.